Let's look at options. So, what is an option? Simply put, an option contract gives one party the right but not the obligation to buy or sell an underlying asset at a specific price by or at a specific date. If the party that has this right to buy or sell chooses to exercise their right or option, the counterparty to the contract must deliver. The two basic option types are a call option and a put option. A call option is the option to buy an underlying asset at a specified price in the future, whereas a put option is the option to sell an underlying asset at a specified price in the future. What is the purpose of an option? Well, options can be used for a wide range of hedging and speculating purposes. Since options give the right but not the obligation to exercise, investors who buy options can use these options to speculate while also reducing downside losses. We can also combine options together, combining calls and puts in many different ways to execute unique strategies that we'll look at later. Let's look at examples of both types of options. We'll start with the call option. In this example, we're going to assume the holder of the option has the right to buy 1,000 barrels of oil at $50 per barrel in 1 year's time. Let's now fast forward a year and let's assume that the spot price of oil is $55 per barrel. Then the holder of the option would exercise the option because the choice the holder has is to buy in the spot market at $55 a barrel, when under the call option contract they can buy at $50 per barrel. If the price in the spot market a year from now was lower than $50, the holder of the option would not exercise the call option. Now let's look at the put option. Let's assume the put option gives the holder of the option the right to sell 600 troy ounces of gold for $1,500 per troy ounce in 6 months. In this scenario, if the price of troy ounces was higher than $1,500, you would not exercise the option because you could sell your gold in the spot market at more than $1,500. However, if the price of gold per ounce was lower than $1,500 per ounce, then you would exercise this option because you would be selling at a higher price, in this case, $1,500 per troy ounce. Important components of an option include the following. First of all, we'll need to understand what is the underlying asset. It could be a commodity like gold, or it could be an equity, a share. Secondly, we need to know the expiration date. Next, we need to know the strike price. We also need to know the contract size. So, for example, the majority of stock options come in contract sizes of 100 shares per contract. We also need to know the type of delivery. Is it physical delivery or cash settled? An important component of an option is also its premium. How much is this option going to cost? We also need to know the type of option. Two common types of options are American options and European options, and we'll explore these in more detail over the next few slides. Let's look at a real call option example. Here we have a Bloomberg screen. The call option is on IBM shares, IBM being a US-based company. In the top right of the screen, you'll see the underlying IBM share price or stock price, which is 143.575. Near the top left, you'll see the call option ticker. IBM, the first few letters of the ticker, highlight the underlying asset and that it is a US equity. Next, we have the expiration date, which is January 17th, 2020. This is followed by the letter C, which stands for call option, and then the 140 represents the strike price. The strike price is the price at which the option can be exercised. So in this case, the holder of the IBM call option has the right, but not the obligation, to buy IBM stock at $140 per share. Next, we have the exercise type. This call option is an American option. There are many types of options. Two common types of options are American options and European options. An American option can be exercised over a period until the expiration date, whereas a European option can only be exercised on the expiration date. Next, we have the contract size. This call option requires the holder of the call option to buy 100 IBM shares, not one share. Finally, I want to highlight the delta on the screen. Delta is the relationship between an options price and the price of the underlying asset, in this case, IBM stock. A delta of 0.598 means that if the stock price of IBM goes up by $1, the option price will rise by 59.8 cents. Now let's look at a put option, real example. We're looking at an equity put option for the same company, IBM. We'll start by going to the top right-hand corner, and you can still see the price, the underlying price of the IBM shares when this Bloomberg screen was taken was $143.54. We then can turn to the ticker. Here the ticker looks very similar to the one before. The only difference is the C has been replaced by a P, with the P representing a put option. We've left the strike price at 140, but in this case, the holder of the option has the right to sell IBM stock for $140 per share. Again, it's an American option, which means that the holder of this option can exercise their option through the period until the expiration date, which is 17 January 2020. The final thing we see here is the delta. And what's different with this delta is that it has a negative sign in front, and that's because it is a put option. The delta, recall, is the relationship between an options price and the price of the underlying IBM stock. A delta of negative 0.413 means that if the stock price goes up by $1, the option price is going to fall by 41.3 cents. Here we can see the profit and loss or payoff diagrams for a long position and a short position related to a call option. The owner of the option or holder of the option, we say, is long that option. So in this case, they would be long a call option. The profit and loss or payoff diagram for this position is on the left. Where the blue horizontal and vertical lines cross is neither a profit or a loss. It's zero. Anything above the line is a profit. Anything below that line is a loss. The K that you see on the graph stands for the strike price. So let's imagine that we're talking about oil, and the strike price of oil is $50. That's where the K would be. Now, let's also assume that the option costs the holder $1. If the option is not exercised, which is where the graph starts, the holder of the option will be sitting on a small loss, the loss being the cost of the option, or $1. However, as the stock price goes up and beats the strike price, so let's imagine that the stock price of oil goes to $55, well, then the option will be exercised because the option allows the holder to exercise at $50, which means they'd make a gain of $5. However, their net profit and loss would only be $5 because the cost of the option was $1. On the right, we have a short call position. You'll see that it is inverted, or in some ways is a mirror image of the long call position. If the strike price, which we said for oil was going to be $50, is below $50, the option will not be exercised. That means the short position, or the writer of the option, walks away with a small profit, which is the premium of $1. However, as the spot price of oil goes up, let's say it goes up to $55, the short position will start losing money. At $55, recall that the long option holder is going to exercise that option and therefore have a profit of $4. For the short call position, that means they'll have a loss of $4. They have to sell the stock for $50, buy it at $55, losing $5, but they offset that loss of $5 with a $1 premium. Here we can see the profit and loss or payoff diagrams for a long position and a short position on a put option. The long put position is someone who has bought the option and it's the right to sell shares or the underlying asset. In our example, let's assume it's a long put on oil. So the holder of the put option, the long put position, has the right to sell oil for, let's say, a strike price, which is represented by the K, of $50. Let's now imagine that the price of oil in the spot market is $55. The holder of the put option will not exercise their right to sell at $50 because they could sell in the spot market at $55. So they'll be sitting on a small loss, that loss being the cost of the premium, which we can say, for example, is $1. However, if the price of oil in the spot market drops to, let's say, $45, then the long put position will actually exercise the option and therefore will have a profit. So the option holder has the right to sell oil at $50 a barrel when in the spot market it is selling at $45. So there's a gain of $5. However, we have to offset the cost of the premium, which would mean that the long put position is sitting on a profit of $4. A profit of $4 for the long position means the short put position must be making a loss of $4. Let's pause to talk about a term called moneyness. Moneyness refers to whether an option has intrinsic value at a point in time by comparing simply the strike price with the underlying spot price. Here we have a call option payoff or profit and loss diagram. If, for a call option, the spot price is greater than the strike price, we say that the option is in the money. You may see the initials ITM for short. If, for a call option, the strike and spot prices are the same, we say that option is at the money, or ATM. And if the spot price is below the strike price for a call option, we say that is out of the money, or OTM. We'd use the same terms for a put option, however, the reverse would hold. If the strike price was higher than the spot price for a put option, that would be in the money. And if the spot price was higher than the strike price for a put option, then we'd say that was out of the money.